Good morning, ladies and gentlemen. My name is Ryan Souza. I'm one of the senior investment managers here at Sharewise, and we're here this morning with CEO and Executive Director of Sequoia Financial Group, Garry Crole. Now, Gary's been kind enough this morning to lend us his time and expertise regarding SEQ. As always, he's going to kick things off with a bit of a presentation, and then we're going to open the floor up to Q&A. So I've got a couple that will get the juices flowing, but ladies and gentlemen, if you have any questions you'd like me to ask Garry, please do submit them through using the Q&A function on Zoom. Garry, thank you very much for your time again this morning, mate. She's all yours.
Right, no, thank you. And hopefully my presentation slides are showing now.
So they aren't showing, so do you want to just try sharing screen again?
Okay. Apologies, you'll have to remind me how to do this, Ryan.
That's all right. So it's the green share button on the bottom bar of Zoom.
Here we go.
There we go. Spot on, mate. Thank you.
So apologies for that. And thank you for your time, Ryan. I appreciate the opportunity to discuss Sequoia and what we do, and a big fan of your website as a user and reader. So I'm very pleased to be here today. What I'd like to do for the listeners today is basically just give you a bit of an overview of Sequoia. I assume that most people, with Sequoia being a small cap stock, is something you haven't heard of. And one of my beliefs in investing is if you don't understand a stock, you should not invest in it. So hopefully today I can give you some idea about what we do and what we're trying to do as an ASX listed company that is quite small. Our market cap is $50 million. And we obviously have plans to grow that over time. I'll just do a short disclaimer. None of the things that I'm doing today is personal advice of any nature. Everything is general in nature. So obviously, if you are thinking about investing, you should speak to a financial planner, and that's what we do. So we are happy to discuss the disclaimers and the importance of getting personal financial advice. Looking back, just to give the viewers a bit of an understanding of our full year 24 results. Our revenue for the 12 months was $124 million. Operating profit of compared to the previous corresponding period of the businesses that are currently within Sequoia, generated $8.7 million of operating profit. Net profit after tax was very high for a market cap of $50 million, so it was $24 million. We had a one-off capital gain on a divestment that we had, which gave us a lot of cash and also gave us a one-off net profit after tax. But on a normalized basis, I think that's what investors should be looking at, is the operating profit of $8.7 million and the operating cash flow that comes from the normalized business. And also looking at the dividend from a normalized basis. So we actually paid out 7 cents per share in 2024 as dividend. 2.5 cents of that dividend was abnormal. As a result of the divestment, we gave some of back to shareholders for a 7 cents fully franked dividend over the 12 months. But normal dividends was 2 cents in the first half and 2.5 cents in the second half, for a 4.5 cents per share fully franked dividend. And at 30th of June, we were sitting on $16.8 million of cash, which was a 79% increase on the previous corresponding period, and we have no debt. We have 125 million shares on issue. The shares are trading around 40 cents. So your market cap is around $50 million, and we've got, as I said, $16 million. $16.8 million of cash at 30th of June. We did pay a 2.5 cent dividend, so it's shrunk a little bit, but we continue to generate operating cash flow, so it's relatively steady. We've over the last few years, we've had some criticism that we've had too many businesses, and it's a little bit difficult to understand what we do. We have streamlined the business over the last 12 months and are continuing to do that. in essence, what Sequoia has two major business divisions, and we provide services to financial planners and accounting firms and high net worth clients. So the two divisions that we offer, one, I think Sequoia is primarily known, for those that do know you, in licensing and advisor services. So we provide financial planners the opportunity to be licensed by us, or we have salaried advisors within the group, things such as corporate finance, family office, salaried advice businesses, but primarily the major business within the licensee and advisor services is to offer a license to the 15,000 odd financial planners that are out there in the community looking for a license. We provide 360 advisors a license under the Interprac or Sequoia Wealth Management brand. And that makes us the 6th largest licensee in the country. It's something that's is not necessarily an aspiration of us to be the biggest licensee. We want to be the most profitable licensee and have high quality advisors. Growth is important, and we have aspirations to organically grow the number of advisors that we do license. From an acquisition perspective, we are more interested in acquiring salaried advisors into our salaried advice business, because the margins where you own the book as such and own the opportunity to act directly with a client is a lot higher. You're looking at 25 to 30% margins, where in the licensee business you're looking at much tighter margins, and that's one of the areas that we're certainly looking to focus a lot more on in the future. The legal and administration services business is actually a lot simpler business, and it's a lot higher margin once you get to scale. What we do currently is we provide accountants and financial planners the opportunity to set up companies, trusts, and super funds. So when a consumer goes to their accountant and they want to set up a company or a trust or a family trust or any type of legal structure, the accountant generally goes to an outsourced provider and acquires that for that client. And we're one of about 40 providers. We are probably the 4th largest in the market. Hub24 and another company owned by private equity are the 2 largest providers with about 20% market share. We have about 10% market share. The challenge with this business is it's you need a lot of IT and you need a lot of technology to get the benefits of scale. We have now well and truly surpassed that, and if you look at our financial numbers, because of the volumes that we're now doing, the margin is spreading, and the organic growth is really making this particular part of the business very, very attractive, and it's probably a bit of a hidden gem within Sequoia. But I would expect in future years there's going to be a lot more focus on us growing this part of our business. If you do look at those numbers now, I'll just touch on that. So in the full year 24 period where the numbers have been disclosed to market, we had a 55% margin improvement. So on $9.3 million of revenue, we generated $4.2 million of EBITDA in this particular business. So you're looking at a very nice margin business there, and much better than what you're getting in the other part of the business. So what highlights this is revenue only grew from $7.7 million to $9.3 million, so a $1.6 million revenue growth. However, EBITDA went from $2.2 million to $4.2 million. So you've got more than 100% return on the growth in revenue, because the investment that we had previously in technology had reduced somewhat, and we were able to put up some pricing. So that should continue. We would expect to continue to see revenue growth at 20% plus organically, and margin expansion in this particular business. There's 10,500 accountancy firms in Australia that have clients come into their offices each day and every day looking to set up their structures. of those 10,500, 1,200 accounting firms use Sequoia to set up their company's trust and super funds. That customer base is obviously very large. We're doing approximately 200 to 220 new structures per day from a range of accountants. Some accountancy firms might only do 4 or 5 a year. They don't have a lot of clients setting up new structures. Other accountancy firms are doing a lot more. So we're targeting at the top end of town to get higher return per accountancy firm, but we're also looking to upsell and provide additional service to those accountants that are already using us, such as secretarial services, such as administration services, such as back office self-managed super fund administration to those accountancy firms, so that we're getting more earnings from those 1,200 accountancy firms that use us. The National Tax and Accountants Association, NTAA Corporate, is one of our clients. So the NTAA has 9,000 accountancy firms as members of their association. So they have a very high penetration in respect to membership. We are their partner in this business as one of our brands, and we're looking to maximise that relationship and expand organic growth. We're also very open to acquisitions in this particular area. We've made 2 or 3 acquisitions over the last couple of years, and that's what's driving this margin expansion. It's all about scale and technology. Our technology is top end. The licensee services business, as you can see, is a much harder return business in respect to the revenue you generate for the EBITDA that you get. So this is before head office costs. So as a division in its own right, revenue went from 89 million to 113 million, and EBITDA went from 4.4 million to 8.4 million. So that's in a sense a good return, but it's 7 or 8% return on revenue compared to the other business, which is the type of returns that you can really escalate, and we're getting. So we are keen to stabilise revenue in this particular part of our business, get higher return on that revenue in respect to having salaried advice and providing more services. But it's not about having as many advisors as we can possibly license and getting a very small return on each one of those, because that's as you can see, it's a 7 or 8% return on revenue business, and that's not something we're looking to have as our core focus. We're looking to have minimum type revenues of 15% across the board on total revenue, and it's about the quality of the revenue and the opportunity to expand margins over time. The good thing about the salaried advice business in particular and the corporate finance business in particular is that the demand for financial advice is accelerating as the population ages. So, the superannuation guarantee charge that was introduced quite a long time ago now has seen most Australians over 45 years of age with a relatively good superannuation balance and in a position to engage a financial planner from 45 onwards to the end of their life. The number of financial planners providing services to those retirees and expectant needs has halved. So the demand is probably doubled and the supply of service providers has halved. So what you're seeing is each individual financial advisor in their own right is doing extremely well. The licensees that provide the services to those financial planners are on a pretty squeezy margin. However, the salaried advisor businesses themselves are getting very, very good margins, and the demand for their services is increasing. So that's a thematic that we're looking to push greater towards. So we're an acquirer of retiring advisors' businesses. We're an acquirer of businesses that would like to be in a bigger organisation, and that's certainly going to be a key driver for us in the next 2 to 5 years. The company has a goal. We understand that being $50 million market cap as an ASX listed company is almost lacking relevance. We need to be a company that's got opportunity to go to a $200 million market cap. So the fund managers, the institutions, and and people can invest in us at this particular point in time. We recognise, despite having a 10% fully franked yield, that we're too small for the majority of those fund managed institutions to back our story, despite our track record of being actually very good. Looking forward, I sort of touched on the past a little bit there. Since June 24, since the financial results, we've done some more streamlining. The business continued to really think about what services can we provide an accountant, and what services can we provide a financial planner, and what services can we provide the community that wants to work with a financial planner as the core reasons for operating. We've had a number of businesses over time. At one point in time we had 20 different small businesses. We've reduced that down significantly over the last 18 months, and now we have 2 main divisions with about 12 individual businesses. We've sold 3 businesses that didn't meet our return on capital criteria in the recent times. So we sold recently Informed Investor to another listed company, which we took some shares in, which we're quite excited about that particular company. We have formed a relationship where they're going to use our media business to operate, to promote their particular investments. So they're a fund manager and a high net worth investing company themselves. Corporate Connect, we've also recently sold, and Taking Control was sold. So we've sold those 3 businesses that weren't making profit and taking up head office time, and really allows the management team to focus on what we can do better in the longer term. We've also further invested in technology in those 2 core businesses to become better at what we do in this particular half and then the back end of last year, and that really sets us up for strong organic growth. In particular, in that document business, the legal and document business, we could double our turnover and not have to add hardly any staff, because it's now very much a technology play. And as you can see from those results I talked about just before, the margin expansion on that is very high. In fact, it's almost 90 cents in every new revenue dollar that comes to the top line, to the EBITDA line, once you've reached that critical scale now. So if we did grow 15 to 20%, you could really hope to see most of that hit the profit line. We had over the last 3 or 4 years, we had a heavy focus on providing thematic investments in specialist investments over time, which was is using gearing to access a market with some protection on it. We believe that as interest rates have risen and as markets have become toppy, we felt that that's a bit too high a risk profile. So we've really scaled back our new business in that particular area. We've had a management restructure in the specialist investments area, and we've formed some strategic relationships with some key market players to access product, but not necessarily manufacture as much product as we did in the past. And it'll be less geared product and far more conservative in the future. We also restructured in the last 6 months with the sale of Informed Investor, Corporate Connect in particular. We've merged our media business, being the Financial News Network website and the Share Cafe website, into one entity, and we'll launch in the next month or so an enhanced digital platform with improved content under the leadership of Jed Bartelli, who comes to us from Ticker TV and other media businesses. So we've put a media person in charge of that particular business now, and we think that's going to be very, very important to promote accountancy practices businesses to the it's going to be in some ways an IR business as well as a news business, and we're looking to provide content for our financial planners, our accountants, fund managers, advisors and ASX listed companies to a very broad audience of people, and we think that will be very critical in our growth aspirations. For example, we'll be educating accountants' clients about the benefits of having a family trust, the benefits of having an SMSF, the negatives of having an SMSF, and really becoming an educational website for our clients, being the 1,200 accountants that currently use us. The other thing is, as I touched on before, we did have $16.8 million at 30th of June 2024 in cash and listed in shares. We actually have two investments, Uri and Morrison's, that we own 20% of. So excluding those investments, which have a strong asset value, we currently have $15.6 million of cash, and that comes after the distribution of 5 cents per share in September 24. So cash has dropped from 16.8 to 15.6. However, we did pay out 5 cents per share in that period. So that was around $6 million of dividend. And we have been continuing, less so more recently, but we've successfully reduced our shares on issue from about 135 million to 124 million over the last 12 to 18 months. So we have 124 million shares on issue. As I said, trading about 40 cents per share, market cap around $50 million, with $15.6 million of cash available, and a business that's generating cash each and every month. And I might just touch there, because I think one of the most important things, Ryan, from my perspective, is to this new audience for us is to tell that story and take questions.
And that presentation was absolutely brilliant, Garry. So thank you very much for that one. I've got a couple that I really want to kick us off with. And then obviously, ladies and gentlemen, if you have any questions you'd like me to ask Garry, just remind you, please submit them through using the Q&A function on the Zoom, and then I will ask away. So first one, mate, obviously, you guys seem to be operating in a pretty heavily evolving financial landscape, particularly in the light of, your adoption of technology as well as changing regulatory environments. How is SEQ adapting to a landscape that's constantly changing?
Yeah, that's a good question. I think one thing that over my, as people can see, I'm not a young man. Every my 35 years in this particular industry, every single year there's been just massive change, and it just never ends. But I think from our perspective, what will never change is the need for advice. Australians don't engage with financial advisors enough. The population is increasing in its wealth, and only 16% of Australians with enough wealth to engage a financial planner are engaging one. So that demand is critical for a business like us, and we're using technology more so now, and we're learning from that to be able to reduce the cost of advice. So a lot of people who would like to get advice just feel the cost is too high. It's around $4,000 to $5,000 per client is what a financial planner tends to charge for an annual service. Yeah. So getting looking at the cost benefit analysis from the consumer's point of view about whether that's worthwhile is a discussion that a lot of families are having. But what we're tending to see is that the value is coming through. So those with an advisor are very high advocates for those without, and we're seeing that, and technology is driving that. And unfortunately for the consumer, the more that changes with tax, the more that changes with structures, the more that changes with volatility of returns, the more the community needs an advisor to hold their hand and give them the confidence to stay in their risk profile. Because one thing that tends to happen is people tend to buy when markets are high, and they tend to sell when markets are dropping. And if they've got a plan, they don't fall for that trap.
Right. Well, brilliant. Thank you for that exploration there. Now, just shifting gears here, obviously, financial services industry is one that's very heavily saturated, lots of competitors. How does SEQ actively differentiate itself from its competitors, and what competitive advantage do you guys present to the market?
So I think on the there's two sides of the business. So the competitive advantage for the legal documents business is that our documents are overseen by lawyers. So a lot of the shelf companies you buy, you're just buying a document. Some documents you can even use artificial intelligence to create a document. The documents that we're providing accountancy practices and consumers is of the highest standard. So we are really believing that we've got the best quality documents that a consumer can buy for their structure, and they're acquiring them from at a unit price that is around $150 per unit. So very low cost, very high quality. It's all about scale. The other thing is the technology that we've got in place to allow someone to set up a company, trust, or super fund with the ABN, with the bank account set up, with everything ready to go. Because of the technology, it's like about a 2 to 3 minute process. So the accountancy practice goes line to our technology, puts in all the information, all the alerts to not make mistakes about having common directors and all sorts of things like that. All the addresses scale straight up into the ASIC website, into the ABN. People can't make mistakes, and they can either have a soft copy in their email within minutes, or they can get their company structure sent to us overnight in a nice booklet and looking nice and pretty to have in their shelves. On the financial planning side, the point of difference in respecting licensing advisors is that we're their business partner. We charge a low fee to help them give good advice. We have regular training. We have weekly webinars for our financial planners. We have business managers helping them with coaching. It's a lonely business if you're a financial planner out there in the suburbs or in the country, and we really partner with those financial planners we provide a license for to help them be a better business, and that's our point of difference. We're nimble, we're small, and we're independent to product. I think that's also very important.
Well, thank you for that one, Gary. Now, obviously, you guys, you in particular did mention wanted to take the market cap of the company to an approximate target of around 200 million. Now, with it currently sitting at 50 mil, what are the key growth strategies for SEQ within reasonably probably the next 5 years? Is it mainly going to be done through targeting organic growth, or is it more merger and acquisition focused?
So I think it's probably equal to both. So I think that it's all about, the market cap is just not going to happen because we want it to happen. The market cap, in our opinion, will change because people believe in the consistency of earnings and the consistency of dividends. So the current dividend, is a 10% fully franked yield. Like that's really high. But I think the market's probably of the belief that maybe they can't sustain that. So we're not getting rated for that past dividend. What we've got to be able to prove is that we can continue to grow earnings, cash, and we can continue to pay out that earnings in dividends, and we can continue to grow at 10 to 15 to 20% growth organically while in respect to revenue, while spreading our margin. So that's the key. I think it's a trust factor. I think it's people not knowing about us factor. It's a moving share register factor. We had a whole heap of shareholders come into the stock at 20 cents when the stock went to 60. You had a changing of the guard. I think it's just about, I've talked about it before and I don't want to go on about it too much, but we want to be the tortoise, not the hare. We want to get back to just delivering consistent revenue growth, consistent earnings growth, paying good dividends, so that the shareholders can hold the stock and trust that it's a long-term income and growth story for them.
All right, well, thank you for that one. Now, just one last one from me on the topic of your dividends. Obviously, having a 10% fully franked yield on a 50 mil market cap stock is something that's very attractive. What is the company's dividend policy? At the end of the day, how do you guys go about balancing dividend power when it comes to reinvestment into the business to actually grow it?
Yeah, no, it's a really good question. The board is discussing at the moment. The one thing that we don't want to do is we don't want to be one of those companies that pays out more dividend than you earn. So we want to reinvest back in the business. We don't want to do capital raises in respect to having to raise capital for growth. So we want to use the cash, the $16.8 million cash we've got to make acquisitions. We want to grow that cash, and we want to pay out a dividend that's attractive but not over attractive. So we don't want to be just seen as a yield stock. We want us to be seen as a growth stock that pays a good dividend. So one of the things that we haven't determined next year's dividend, but we would like to grow revenue, grow profit, and continue to pay very strong dividends. Without putting a number that we're going to pay 80% of cash or anything like that. Like if there's acquisitions that we can make that can make the company grow in market cap quicker, that's more attractive to us than maintaining a 10 to 12% yield.
Okay, understandable. Thank you for that one. Now, we'll just move to a couple of live submitted questions here. First one I've got is, how healthy is the relationship with NTAA after the EGM?
Extremely healthy. So there was some questions about that one of the shareholders that was calling for some changes for the board. That relationship is super strong. We have a 5-year agreement in place, which is only 9 to 12 months old. Coming up to an anniversary. I'm not sure exactly when the time is, but it's got a long term to serve. Since the EGM, in fact, the relationship has been maybe even better. It's very, very positive. We're working really closely with the NTAA. We're attending their seminars. We are working closely with them on improving product and services. Relationship is exceptionally strong.
Brilliant. Thank you for that one. Now, just another one submitted here. Can you give any info on the performance of Yuri and Morrison's? Is there an exit strategy for these investments or any view on how we should value these? i.e., is the book value carried? How should we view it?
So both are quite separate. So the Yuri business is going exceptionally well. So it's a business that commenced. James Hurd is the CEO of that particular business, and he's grown his fund management business, which is a balanced fund, a growth fund, and a property REIT fund, from zero about 14 months ago to about $150 million of funds under management in that 14 months. So that's exceptional growth. The business is profitable. It's generating cash. It's not in a position to pay dividends yet because it's really all about growing to be hopefully $1 billion fund. We like the investment. If someone came along and offered us a price that was well above what we invested, we may consider divesting it. But at this stage, we're really excited about the growth. The performance is in the top quartile with Morningstar in all 3 funds. So it's provided exceptional growth from the financial planners that use Sequoia's perspective. Some of those are beginning to use the fund and they're getting really good returns for their clients. So that relationship's good. James is a great advocate. Clients, because of his football background, know him, and the underlying clients that the financial planners use, he's open to doing seminars for clients, and it's been a really positive relationship. In respect to the Morrison's investment, Morrison's is since we divested 80% and maintained 20%, their numbers have continued to grow, not as quick as they were growing within Sequoia, but the turnover is up about 10%. It's a profitable business. Whether we divest or not divest, it's not something we've had a lot of discussions about. But in respect to book value, we're comfortable with both.
Well, brilliant. Thank you for that one. Now, another one here. The Morrison's purchaser was in administration, and Morrison was sold to Beacons. What is their intention with Morrison's? How has Sequoia's involvement changed?
There's been no change of involvement. So we continue to maintain 20%. The Beaconsfield people are some of the shareholders that were shareholders of New Quantum. We've had ongoing meetings with them. The relationship is very good. They've got a lot of plans to grow a part of that business. They've employed a couple of new people into that business. We sold the Corporate Connect business to one of the parties associated with them. So everything is positive in respect to the new relationship. And they're looking to really scale up. So we want to be a part of that scale up with them and see the whole of that Morrison business increase in value and service. We're a client of that business, and the service levels are really good. And we're happy with that relationship as it currently stands.
Well, that wraps up all the questions that we've got, Garry. So thank you very much for your time again this morning. Is there anything you'd like to leave us with?
No, I'd just like to thank you for the opportunity and congratulate you on your media site and all the things that you do for the financial advice community, and thank you for the opportunity of meeting your community.
Well, thank you very much for your time again this morning, Garry, and thank you very much, Sequoia, as well. Ladies and gentlemen, enjoy the rest of your day. Cheers.
Thank you.